Welcome, everyone. Thank you for joining me and joining all of us tonight to talk a little bit about thinking about charitable giving and planned giving. This is something that's actually a long time in the works. Rob and I have been talking about this for years, honestly, that we wanted to begin to do some education about not just planned giving, but also charitable giving. There's a lot going on with the church right now, and it made sense to pull it all together and to help people think a little bit more intentionally. My name is Lisa Kirchenbauer, and I am the chair of the investment committee here at St. John's, and I'm also the chair of the Planned Giving or 1816 Society committee, and I can talk a little bit more about that as we go on here. And so this is what I do too. It's wealth management, and so these are things that I talk with my clients about a lot. The reason we think this is very important to begin this education and conversation, as some of you may know, and I'll allude to it more in the slides, back in 2017 there were a number of tax law changes, including estate tax changes. And so for the last 7 years, a lot of people haven't had to worry about federal estate taxes. But shortly, most people think by the end of next year, that is going to change a great deal. As it turns out, there are a number of people who currently have a Maryland or a DC estate tax issue, whereas if you live in Virginia, probably not for the moment, but Virginia follows the federal. So a lot of people are going to need to be thinking about this. And as I said to some of you as we were having our reception, most estate planning attorneys have said to me that if potential clients or clients wait until next year to start working on their estate planning, they can get in line behind everybody else who started their planning already. So that's why we're having this conversation now, is to help you prepare. And also, like I said, we have a number of different charitable efforts going on here at the church right now, and I've been wanting to talk a little bit about some different strategies that maybe people hadn't thought about. So first, charitable giving versus planned giving. I think that's the first thing I want to make sure we understand. So charitable giving, when I think about it, is giving when you're living. And we have a lot of that. We have a lot of generous parishioners here at St. John's. There's a number of ways that you can do that. We'll talk about that during your lifetime, different vehicles, different investments that you can use. And so that's giving while you're living. Planned giving, I think, has come more to the forefront here at St. John's with the very generous gift we got from Dorothy McCauley last year. And that is planned giving. That was, and we're going to talk about it a little bit here, that was basically a charitable remainder trust that got to the end of its life. It had paid income to everybody it was going to pay income to, and then it was time to pay out the remainder, of which St. John's was fortunate enough to get a significant amount of money. So it's an example right in our church's life and history now. And it's actually a vehicle that we have not seen used very much here at St. John's, but I think is something that could be valuable for the right person to consider. So hopefully that makes sense as far as charitable versus planned giving. I'm going to talk about both, and again, different strategies for both. So one of the things before we jump into all of the technical side of charitable and planned giving, I want us to stop and take a moment to be a little more intentional, because I think sometimes everybody, especially, does charitable giving differently, where maybe your CPA has told you it's the end of the year and you're going to have a big tax bill and you need to do something, or maybe you had a liquidity event and again there's a big tax bill to pay and you just go ahead and do something, not really thinking exactly, is that really what I intended? And so I put some questions together here that I would encourage you to think about a little bit in terms of an intentional, integrated, charitable and planned giving strategy. So the first thing, and there is not a wrong answer here, by the way, charitable giving as a tax strategy or as an impact strategy. It's perfectly fine if you're doing it for tax planning reasons. So it doesn't have to be loftier than that, but you certainly want to understand what you're doing. An impact strategy, though, is more of a, you're trying to affect change leave a legacy, impact a community, a charity, whatever. Yes, you may be getting a tax benefit as well. And by the way, you can say yes and yes, or you could say yes, no, no, yes, whichever you want to. But really understanding why you're doing this. And that the reason that becomes important is because your why may determine what's the best vehicle or the best assets to actually give. And then this is a deeper question that I think many of us don't think about, is what do we want to be remembered for? That's, it's something we don't always think about, but especially plan giving is a legacy strategy. When we want to have an impact after we've left this planet, what do we want to be remembered for? What do we want to keep supporting? And so it's worthy of consideration because, again, it may drive who you give money to, how you structure things, the directions you leave for others to handle once you've actually left. And then when to give, just as a great example is a lot of people think that they should do their charitable giving at the end of the year. Or I should take my required minimum distribution at the end of the year, which you can then send to charity, and it's called a qualified charitable distribution. You don't have to wait till the end of the year, but if you do it before the end of the year, you do actually need to coordinate with your advisors to figure out what makes sense, because once you do it, you're done. You can't go get that money back, but you don't have to wait. So I think that's important to understand because a lot of times it seems like people think that all the charitable giving needs to happen at the end of the year. And honestly, including St. John's, we could use the money sooner. So having to wait till the end of the year, not knowing what we're going to get, as Rob can attest to, biting his nails, wondering who's going to pledge, it would be great for us to know sooner. And actually, on that note, one of the things that we're working on behind the scenes is, planned giving at St. John's, the way we recognize that is through what is called the 1816 Society. So if you have named St. John's in your will, in your trust, in a beneficiary designation on life insurance, retirement plans, whatever it might be, we want to know about that. We know of a number of people who have made that decision and have communicated it to us. But right now we're updating our records, and we're actually going to be coming back to everyone to ask them not how much, but how are you doing your planned giving on behalf of St. John's, because we really need to understand the mechanism, the vehicles, just to help with our long-term planning. So if you are already on the 1816 Society list, we're coming back to you again to ask for a little bit more detail. It's never too early or never too late, except when you leave the planet, then you're done on all fronts, unless you did set something up in your plans, and then you're good. I think, yes, Justin.
So Lisa, quick question for you.
Yeah.
So I recognize this may be more suited for a legal or an estate professional, but typically when we think about beneficiaries for an IRA or a brokerage account, we think of people, right?
Yep.
So can we literally just put an organization such as St. John's as a designated beneficiary on an IRA?
Yeah, we can, and thank you for teeing that up. He's the plant in the audience here. So yes, we can. The one thing I would be very, very careful about, and this is something we also need to communicate a little better, is we need to be crystal clear on which St. John's. You don't want to just put St. John's Church, because there's a few of those in town. And so it's really important. Lafayette Square is how we identify ourselves. And so, and then we have a tax ID number. So it's important to, yes, you can do that on life insurance, on retirement plan accounts, on transfer on death accounts. We can name a charity. But please make sure that you have the right St. John's, so it doesn't go to another church that you didn't intend it to.
So my point here too is, Lisa, and follow-up, thank you for that clarity. Typically, people might think of planned giving as I need to establish a trust, or certainly including that information or language as part of the will, but it could, to your point, be as simple as a beneficiary designation.
Yeah, because if that's all you have is maybe a retirement plan account, but you'd like, and you don't have to, it's not 100% or zero, you can say 10%. The one thing I will say that people don't always understand, because I'll hear clients or other people will say, oh, well, it's in my will, but then I have something different on my beneficiary designations. Your beneficiary designations supersede whatever your will and trust say. So if your intention on your will and trust say one thing, but your beneficiary designations on, let's say, your IRAs say something else, the beneficiary designation will supersede anything else. Just on that money, just on that money.
But doesn't the trust supersede the will?
Not unless your trust is named as the beneficiary. No. So it's only on that account. So on a particular IRA account, if you say my primary beneficiary is X, X is going to get it regardless of what your trust says. Maybe your trust has money going other places. That's great. But sometimes people think that what they put in their trust and will is more powerful than what their beneficiary designations are, and that is not the case. Yeah, thank you for that. Thanks for the question. One of the questions that we get at all levels of wealth, so maybe you have less means, maybe you have very significant means, is do I have enough to give? Well, that's always a good opportunity to talk to your friendly certified financial planner and actually run some numbers to figure out, well, if I gave this much every year, or if I gave this much later on, am I impacting my financial situation or my family's financial situation? That isn't hard to model. And we do that all the time because people aren't sure, like, how much can I afford to give away? We can answer that question. So, and there's lots of software out there these days. If your situation's pretty simple, you can probably figure it out. But if your situation's more complex, then you can run different kinds of scenarios. So that comes up a decent amount, even when you have, more significant wealth. And then, as I was just alluding to, do your estate plans align with your giving? So a lot of times we'll find that clients will nudge them to update their estate planning documents. There's going to be a lot of nudging in the next 12 to 18 months. And I can talk a little bit about some of the changes that we see coming. And I don't mean the tax law changes, but what estate planning attorneys are suggesting. Sometimes people get their documents done. They sign them, they're witness, the whole thing, but then they don't change the titles on their assets or their investment accounts. They don't change their beneficiaries, but they think they're done. And you're not done until you make sure that the titling matches. Like, if you want things to be in the name of your trust and follow what your trust says, it needs to be the title on that investment account or that house or whatever. If you've just got a trust over here and nothing is in the name of the trust, it's as good as not having it in place. And then likewise, sometimes, and I'm sure Justin has found this too, is people forget to update their beneficiaries. Your first husband, kids that you honestly don't want to leave the same amount of money to, a charity that's gone defunct. It happens all the time. And so there are some ways that we can work around that, because changing beneficiaries is very easy to do. It's a form. Except for like the thrift savings plan, not so easy. But other than the government's 401k, most things are easy to change beneficiaries on. But to change the terms of your trust or your will, normally, ideally, you need an attorney. It costs some money. It takes some time. So you have to, but it's worth considering, because what you don't want is things in conflict, or your wishes to not be delivered on your latest thinking and your latest wishes. So it's important that it's not just get the documents done. You need to follow that all the way through to implement your estate planning. And that's how we can ensure that things end up the way that you want them to. Make sense? Okay. The part of the reason that we're having this conversation tonight is because there are, as I alluded to earlier, some tax law changes coming. Back in 2017, there was the Tax Cuts and Jobs Act that was put into place. It raised the estate tax exemptions, how much you could exempt from federal estate taxes. There were other changes, some of which we'll talk about here, related to charitable giving. There were many changes that were made, but those are most likely going to expire at the end of next year, so end of 2025. They are tax laws, so don't worry about the presidential election. It matters what happens with Congress, because a lot of people are angsting about the presidential election when it comes to this stuff. It's, you need to be paying attention to what's going on in Congress. But regardless, things may end up mixed as far as who wins. And I think most folks think that those tax cuts and those the things that were enacted in 2017 are going to expire. So I'm going to share with you a little bit about what we think is changing. The most significant is the federal estate tax exemption. It is going to put a whole bunch of people who for the last 7 years have not had to worry about this back in a situation, especially in the DC area where your real estate has some significance. Maybe you've built up some retirement assets, maybe you inherited some money, and all of a sudden your net worth is at a point where you need to be concerned about this. But the last thing I will say is, some of our clients say, I don't care. If my heirs have to pay taxes, so be it. So that's one final discernment you need to think about is, maybe you don't care if taxes have to be paid, but if you do care about sending taxes that maybe you didn't need to send to the government or send to a state or the district, then you actually need to think about some planning. So the changes are that right now, the vast majority of taxpayers on your income tax return are not itemizing tax deductions. There's long story about it, but suffice it to say, many of us, not all of us, unless you're doing significant charitable giving or have significant medical expenses, those are probably the most likely reasons that you would itemize, like maybe many years ago you did. Many people are just taking the standard deduction. Well, that is going to change. A lot more people are going to potentially be in a position to itemize. Well, now that means that doing charitable giving is more important. In a way, a lot of people have been disincented over the last 7 years to do charitable giving, because if they don't do a significant amount, like in the tens of thousands, they're not going to itemize their deductions. They don't bother. They're not incented. And our tax law system is all about incentives. What behavior are we incenting? So we're about to re-incent charitable giving as an example. So there's going to be a lot more people paying attention to that. The next one is an area that gets super confusing, but I'm going to do my best to try to keep it simple. So right now, when you make a cash contribution to, let's say, St. John's or any charity, the amount you can deduct in any one tax year, if it's cash, not securities, not like stocks or mutual funds or whatever, is 60% of your adjusted gross income. Now, that doesn't mean you lose the rest of the deduction. You just have to carry it forward to another tax year. And then for securities, it's 30%. And you might think, well, why wouldn't I just do cash? Well, the reason is that we do securities because we can send, let's say, Apple stock to St. John's. In fact, we had that happen recently. And the parishioner did not have to sell the stock and recognize the capital gains. So they got that big benefit, and then they got to take a tax deduction. And they'll just carry forward. If they can't use it all in 1 year, they'll just carry it forward for up to 5 years, okay? The cash contribution limit is going to potentially go from 60 to 50%. So it's not a big change, but it means, you can get a little more bang for your buck right now, and this is where planning becomes important. Do you have a big liquidity event coming up? Do you have a big income year coming up? This is when you want to work with your financial advisors, you want to work with your accountants to see what year might be the best. Should I bunch a bunch of contributions together? Like right now, we're asking for our annual pledges, and we're looking for bell tower money too. So this might be one of these years where you bunch things together and get a little more bang for your buck, but I can't tell you for sure, should you do cash, should you do securities? That's something you have to work out in your own personal situation, but there is a potential change there. And the last and probably biggest change, again, is related more to planned giving, and is around estate tax changes, is the federal estate tax exemption right now is at about 3.6, let's call it about $14 million per person. So $14 million of your assets when you pass away right now goes tax-free to your heirs. If we lose this tax law that's been in place for the last 7 years, everyone anticipates that we're going to move back to about 7 million. And I know that's a big number, but like I said, in the DC area, it adds up pretty quickly between retirement accounts, investment accounts, maybe you've inherited money, and your real estate. So that is going to prompt a whole lot of people to have to revisit their planning. And by the way, if you currently have a family trust and you are worried about an estate tax issue, then you may want to be re-looking at how your trusts are structured. So I'm just going to plant that seed. We're not going to have a long conversation about that. So, why does it matter? Why do these changes matter? So right now, cash giving on charitable giving maybe gives you a little bit more bang for your buck, the 60% versus 50%. What will change, I think, for the positive is if more people are itemizing on their tax returns, taking deductions, then maybe, you do a couple, several $1,000s or $10,000 worth of charitable contributions. You might get to really take that deduction, whereas right now you may not be getting the benefit because of the standard deduction being bigger than anything else you're doing. So suffice it to say, it may be of benefit to those charities out there and such. We will see. Now, the biggest thing is plan giving. So giving away assets while you're living or getting them out of your estate while you're living can help reduce your potential estate tax liability. But you have to get on that, and there are always trade-offs. There is no free lunch. When you don't get to keep control of your assets, but somehow not have to worry about taxes. The way the system works is to get the benefits, you have to give up something. So you don't want to give away everything. And again, that's where we need to involve an estate planning attorney, a tax advisor, a financial advisor to really think that all the way through, not just right now and not just over the next couple of years, but a little farther out. Because you don't want to give away everything and somebody else is controlling it and now you don't have any money. That probably isn't what you intended. Now, I do want to mention locally, as I alluded to earlier, the Maryland state estate tax exemption right now is only at 5 million. So almost 14 million at the federal level, but only 5 million in Maryland. Well, there's a whole bunch of people who may be impacted by that right now. Now, it's not as significant as the federal estate tax cost, but it is something that I think is probably flying under the radar for a lot of people. And the district is at 4.7. So that's worth keeping in mind. Now, Virginia basically follows the federal exemption, so it's up to almost 14 million. It would obviously come down when the federal exemption comes down. So there may even be some estate tax planning right now, not even waiting for any tax law change. That's the other reason why we're having this conversation. Okay, so these two slides are the more complicated ones, and I've done my best. So to put it all on two charts, so there is what am I giving and how am I giving it? So the first chart is what am I giving? So you're going to see there's a whole bunch of things: cash, appreciated securities, so they've made money, and you don't want to recognize the gain. Qualified charitable distributions from IRAs. Donor advised fund, we're going to talk about that more in a little bit. IRA, retirement plan beneficiaries, they aren't really an asset, but they are something that you might consider like a property. But you'll notice that they are not beneficial for some of our shorter term needs here at St. John's. It's really only for plan giving. So just to go back to the top of the chart, cash is a great vehicle for annual giving and for the bell tower effort that we're going through right now. It doesn't make any sense for plan giving. Plan giving is for the future after you've left the planner. Likewise, appreciated securities, again, biggest bang for your buck is right now while you're living for, and we've had a number of parishioners who have given in lieu of giving cash for their annual stewardship campaign pledge, give us securities instead, and then they don't have to recognize the capital gains. They get credit for that against their pledge. Yeah.
When you get securities, do you sell them immediately?
Yeah, actually they called me, and
they're
I told
sold.
Goldman Sachs to sell them. Yeah, yeah, they're sold pretty much immediately so that we don't mess around with any market risk. And then when it comes into the St. John's account, it's valued, and then that becomes the actual value you get. So hopefully there's no delay between your brokerage firm and Goldman Sachs. Normally there is not. And so then that's the value that's used for gift purposes, not when it leaves.
When it gets here is what the value that
Yeah.
that you.
Yeah, and I think we provide notice on that so that you have that for your tax planning records. And then, so, I think one of the other popular strategies we've seen is using qualified charitable distributions. So just a brief primer on this is that depending on your age, at some point in time, on IRAs and retirement plan accounts, you have to start taking money out because that money's been growing on a tax-deferred basis. It lowered your, in most cases, I'm not going to deal with some other vehicles, but it lowered your taxable income when you put the money in there many years ago, and you haven't been paying taxes, but now the government wants to get paid. So, so there is a point where the government forces you to start taking distributions so they can get some tax money, and that's called the required minimum distribution age. It used to be 70 and a half, okay? That has also changed, different set of laws, and so for some people it's now age 73, but for the vast majority of people it's going to be 75 going forward, so it's being extended. But if you're already doing them, you're already doing them. If you're very close to that age, it might be 73, and then for people like Justin and I, it's going to be 75. So you don't have to do it right now, but there's a point where you have to start taking those distributions. And by the way, if you do not take those distributions, it is it used to be a 50% penalty. It's less. Maybe it's 25%. But it's thank you. It's a significant penalty. It just changed last year. It was flummoxing all kinds of people. So, seriously, you need to get the money out. The IRS is not kidding about this. They want their money, and they're going to penalize you if you don't get it out. 50% of the amount, or 25% of the amount that was supposed to come out. It's not, a small amount. So, but what they do allow you to do is to send some of that money now up to $105,000 a year out directly to a charity of your choice or charities of your choice. And it's a great way to manage your taxable income because otherwise when you get that IRA distribution, it is fully taxable to you. So with our clients, we will sometimes do a combination. Give them some of the cash, pay taxes on it. Some of it would go directly to a charity or charities. The one thing you cannot do is send it to a donor advised fund. We'll talk more about donor advised funds in a minute. But we've seen a lot of that here at St. John's where people have been taking their distributions, sending them directly to St. John's, avoiding having to pay taxes on that income, and they're getting the benefit, getting the credit for their pledge contribution for this year. Now you can also do that for bell tower as well. It's not exclusively for your annual pledge. It could also be for a bell tower commitment as well. And for some people, the amount of money that is having to come out is tens of thousands of dollars. The one other thing that people don't always think about is inherited IRAs. More and more people are inheriting IRAs from mom, dad, auntie, whomever, and so they have this inherited IRA. If you are 70 and a half or older, you can actually send those distributions up to a maximum of $105,000 to charities as well. Now, the reality is that most of the people who are inheriting these IRAs aren't going to make it, they won't be 70 and a half when it's going to be a benefit. There's some rules about how soon beneficiaries have to get money out of IRAs. Most of the time now it is 10 years. There's more rules than that, but let's suffice it to say that your child inherits your IRA, they've got 10 years to get the money out. Most of them won't be 70 and a half, so they won't get to do this. But you might have an IRA from your mother or your aunt, that you could be sending some of that money to a charity instead of having to recognize it. So just that's a little thing on the side, but we're seeing more and more of that as people, as the generations change and the wealth expands. So that was a long story on that, but the But what I was talking about in the first thing, choosing the right property, remember how we talked at the beginning about IRAs and beneficiaries and everything. So there's no benefit of naming St. John's as a beneficiary for the purposes of your annual pledge, but it's a great way to remember St. John's once you leave the planet. But again, make sure you get the right St. John's. And likewise, on life insurance and annuities, I'll come back to donor advised funds because that one is a little bit more complicated. And the real estate, well, technically, could St. John's take real estate? Yes, we could. That would be a little more complicated for us. In fact, I think, didn't we get a call, Rob, in the last year or something, on that St. John's was the beneficiary of either the income from an oil and gas partnership or of the oil and gas partnership, and we were trying to figure that one out. That's why we need to know what you are doing, because we're like, nobody knew about it, nobody knew what to do with it. So, you know, we would prefer not to get super exotic things. They're hard for our church to manage, but we don't want to turn down generosity. So, you know, we'll do our best to work with it.
Super fun sites.
Yeah. You know, yeah. And then, you know, just other miscellaneous things. It could be an actual tangible piece of property that could be given as a gift. That has to be appraised. That follows different rules, but that is something, actually, although I put NA, you can see, you know, if you're trying to get it out of your estate, maybe it's something you do during your lifetime, or it could be something you do. Maybe you have a painting that you are willing to give away at your death. We welcome that kind of stuff. We'll figure it out.
Lisa doesn't know this, but we are going to be the recipient of a piece of art that is Romanian iconography on glass, and from about 200 years ago. That we don't know what it's worth, but it's very special. It's part of a larger collection, and because it's fragile and can't travel, it's going to come to us rather than going to the museum that the rest of the art of that collection is going to.
Is that a giver from this town?
Yeah, it is. So,
Yep. So that happens. It happens sometimes. So now donor advised funds, and I'm going to actually, so a donor advised fund is sort of like a mini foundation. And we'll get to the slide where Renee's beautiful pictures on it. But so a donor advised fund, you basically can put cash or securities into. If it's securities and they're appreciated securities, so otherwise you would have to pay the gains if you sold them. You don't have to. It goes into this donor advised fund. And you can name the fund. You can be the donor that decides or at least recommends where grants are given to charities. The money, once it gets into the donor advised fund, it's got to be granted out to other 501c3 organizations. So it can't be to Billy Joe. You know, it can't be to your sister. It's got to be to charitable organizations. But it is a great vehicle. We use them a lot for clients when they have a liquidity event. So maybe they sold their house and they're going to have a gain, or maybe it's a second home, or maybe they're selling their business. And lots of very, very wealthy billionaires even use donor advised funds because they're a lot easier. In the old days, they would set up a foundation, which is expensive to manage. It is time and money expensive, more complicated. There's all kinds of reporting. Now they just use these donor advised funds under the auspice of a bigger foundation. And it's a fun way, we find with multi-generational planning, some of our families will say, you know, we're worried the kids are going to be spoiled when they get all this money. And one of the best ways to avoid that is to start with charitable giving, is to get the whole family, cross generations, involved in charitable giving early on. And so having this donor advised fund, maybe in the name of the family, maybe it has another special name, is a great way to get everybody involved in where do we want to have an impact out in society and the community. So that's something to keep in mind. So right property, then there's the right vehicle. So how, sort of more instead of the what, the how we do it. And so again, probably pretty obvious that as far as the annual giving campaign in the bell tower, yeah, we're looking for a donation now, not some years in the future, but right now would be preferable, please. A bequest in a will or a trust, that is generally considered to be planned giving. However you choose to do that. And again, beneficiary designations, that does not help the church in the short term. It helps the church in the long run when you leave the planet. And again, now donor advised funds, we could distribute money out of that donor advised fund here to St. John's, here to other charities you care about, both for the Bell Tower campaign as well as your annual giving. And then what's sort of cool to keep in mind, because one of the things that happens sometimes is maybe in your trust you name some you name some charities that at the time, way many years ago, you thought were really great charities. And now, many years later, you've sort of lost your marbles a little bit. These charities don't really exist, and the only way and it's hard to get things changed, to change the beneficiaries, change the charities. One of the things we've had some clients do is to actually name their donor advised fund as the beneficiary. Because then the donor advised fund, it's much easier to change the ultimate beneficiaries. It's just a form. It's not a big legal effort to do that. And so sometimes that's been a benefit, but St. John's could be the beneficiary of your donor advised fund, or at least in part. It doesn't have to be a 0 to, or 100. It could be in between. There's two other things I want to talk about and that I think are important that we really haven't done a lot of here at St. John's in the past, although Dorothy McCauley's gift is an example of one of them. There are charitable trusts, charitable lead trust and charitable remainder trust. So these are especially useful depending on what you're trying to do. So these are irrevocable trusts. Once you put the money into one of these two trusts, it is gone out of your estate. It is no longer under your control. So once you do this, that's it. It's sort of like doing your normal charitable giving, except it has living benefits to somebody. A charitable lead trust provides an income stream to the charity of your choice, and then at your death, the remainder goes to your heirs, often to your heirs. So if you wanted to provide an income stream to a charity rather than just a big outright gift, you could do that. The more common, I think, trust that we see, charitable trust we see, and this is what Dorothy McCauley's vehicle was a charitable remainder trust. So during her lifetime and then her income beneficiaries' lifetimes, there was an income stream, and it's all very prescribed. You can't say, pay out 100%. But there is an income stream that is paid out each year to those income beneficiaries, or if you're the one who started it, to you while you're living. Then, once everybody's been paid out, then any other income beneficiaries you have, the remainder goes to the charity or charities of your choice. You don't do this for $10,000. You do this for more significant gifts, but it is a way to get living benefits while doing planned giving and getting assets out of your estate. And so it's a nice way to do that, as opposed to you just made a gift, money's gone, got a tax deduction, that was it. But it's more complicated, yeah. You're stunned.
I have a question, but I'm not sure I know how to phrase it. So what happened with the trust that we just got all this money from?
So all of the income beneficiaries had been paid.
So that's like people like family members or
Yeah,
who knows?
yeah, and it went on for a long time. I mean, this has gone on.
It could be anybody.
Yeah, I mean, it could be. It doesn't have to be family members.
Okay, yeah,
But the income
anything-
benefit, I don't think it can't be, it's got to be a person, because it's got to have a lifetime.
Okay,
Because then
okay.
when their lifetime is over, we finally got to the end of all the income beneficiaries, and then it was time to pay out the remainder, which was
I
obviously
get it.
significant
Okay, thank
in our
you.
case, right? And so that's a vehicle we really haven't talked much about at St. John's that I want to put out there. Again, it's not for everybody. It is not free of cost. There are costs to set it up, maintain it, and once those assets are in that trust, they are gone. They're not yours. You might be getting an income, but just like when you give a gift, it's gone. So something to think about, because maybe you need to get some assets out of your estate before 2026, but you don't want to just give everything up and not get something for it. You'd like an income stream. This is a way to do that. So something to think about for the future. And if you actually take a look at on slide 9, it actually has a diagram of how it works. And again, more often you see charitable remainder trusts rather than charitable lead trusts where a charity is getting an income stream during your lifetime. I think people just don't use those as much, really. Okay, so I want to say again a word about qualified charitable distributions. We've already talked about this, just as a reminder. Oh, and by the way, I need to say this. So only IRAs distributions can go to a charity. Your TSP, your 401k, cannot be sent to a charity. So you're going to have to roll it out of the 401k, the thrift savings plan, whatever, into an IRA to be able to take advantage of this rule. Otherwise, you just have to recognize the taxes on the income. Hopefully you have an advisor that, if they know you have charitable intent, will think to mention that whole process to you. But that's really important. As it says, retirement plans, you cannot send those distributions to charities. And as I said earlier, inherited IRAs, while not super often, because most of the heirs are going to have all the money paid out within 10 years and they're not going to get to 70 and a half, occasionally the math and ages work, and so that could be a possibility. Yep, for some people. And here is Renee Yancey on slide 11. So Renee, I didn't know Renee was coming, by the way. Yep, exactly.
So thank you, Lisa.
Yep.
So Renee Yancey, a member here at St. John's. I attend the 9 a.m. service, just for reference. And so Lisa, this world that Lisa is describing is the world in which I live. So I'm the president and CEO of the Community Foundation for Northern Virginia. So what is that? Who's heard of it?
Oh, can you come up here? Come on.
Okay.
Otherwise we don't
Thank you.
pick it up.
So beyond Lisa mentioning a donor advised fund, who's heard of a donor advised fund before? Oh, great. Okay, it's a very savvy audience. How about who's heard of a community foundation before? Okay, great. So that's the world. As Lisa described it, the donor advised fund is a charitable investment account. And plain and simple, it is for the sole purpose of managing and supporting the charitable organizations that you care the most about. So St. John's, your alma mater, the local food kitchen, arts institutions, etc. And an entity like a community foundation will manage all of your charitable giving. So rather than each year sitting down with your family and writing checks or making a transfer from your account, you've established this donor advised fund. You contact an entity like the community foundation and you describe, hey, I want to make these 4 contributions this year. We manage it all for you. Or I am interested in conservation. Can you help me identify an organization who's doing great work? So we can do that due diligence. So imagine us as your foundation staff, if you will, to manage all of that for you. As Lisa described, entities such as private foundations often do not provide the same tax advantage. So of course, check with your tax advisor for your particular needs, but generally speaking, a donor advised fund is going to be more tax savvy, a smarter investment for you, and takes away that burden of having to manage staff, having a specific payout amount. And the other beauty of a donor advised fund, you can spend it down to a minimum level and then replenish it as your wealth changes. And for most donor advised funds, you can open them with a dollar amount as small as $10,000. And if you have a certain dollar amount that you've invested in your account, your wealth manager can continue to manage that, the investments of the donor advised fund. Why is that important? Because your wealth advisor will continue to earn fees for the management of the account. Last thing I'll say about the donor advised fund is the wealth advantage of the investment advice. And so your fund will grow over time, providing you are spending within reasonable amounts of the earnings. So they're a beautiful vehicle. Not here to promote the Community Foundation for Northern Virginia specifically, but the act of charitable planning, the act of intentionality, and the act of ensuring that your interests are well thought out, are documented, and that for good forever is here long after you leave the planet. So thank you, and I'm happy to take questions if
Yeah,
anyone has
absolutely.
any.
Thank you, I
Thank you,
appreciate it,
Lisa.
yeah. So, as we get close to the end here, I mentioned this earlier, when to give, what time of the year should I give? And the answer, of course, is it depends. It depends on your own situation. So as an example, let's say you sold a house, sold a property for whatever reason, needed to sell something and we're going to recognize some taxable gains. Well, normally you need to be prepared to make a tax payment. Your CPA is going to tell you need to make a tax payment. So that might be a great time to figure out what gifting you want to do. Go ahead and do it so that your CPA can go ahead and factor that in, and maybe that means you have to send less to the governments. And I say governments, federal and state. Right now, the bell tower project is going on, and we are at least looking for commitments and pledges. You have 3 years to deliver on those payments, but we really need to know who's going to be able to support the project and when, because I can tell you, as the chair of the investment committee, I need to know because we're helping to support the costs of the bell tower project, which is all getting done this year. So it is not too soon to not only pledge to the bell tower, but also give us the money, or securities, we'll take that too. And a number of people have done that. But then sometimes you don't know exactly what your tax situation is going to be for the year. So that's when the year-end planning comes in. So sometimes you do need to wait till the end of the year. And then again, on your retirement distributions, you can take those out any time during the year. That is not an end of the year decision, or doesn't have to be. So if you know by January 1st, because it's based on December 31st prior balance, you know how much you're going to have to take out this year. It's just a question of, do you take it all and pay taxes on it, or do you send off some to the charities of your choices? So it's not a straight, do it soon, do it later. But what I want to encourage people to do is be more thoughtful about it. It doesn't have to wait till the end of the year. And it's hard for charities, to be very honest with you, when the monies don't come in as soon. It's hard for them to plan. And sometimes they've got to finagle some things in order to make the cash work until we get it. Any questions? Okay. And so I want to wrap up by saying, something about updating your estate planning. So here are just some reasons or situations where it may be time to update your estate planning. First of all, if your documents are older than 5 to 7 years, you probably should just at least look at them. Do they still reflect my wishes? Do I still want that friend or that relative to be the successor trustee or the executor of my estate or whatever? Are these the beneficiaries I want to have? So it's always good, if it's been that long since you looked at it, to revisit it. More important is your family situation has changed. Your intentions have changed significantly. So there's more children, there's less relatives, something has changed significantly financially, personally, whatever it might be. That is always a time to revisit your estate planning. And also, one of the things that we recommend doing is that if you have adult children, once they get to be 18, we think it's really important that you or they have powers of attorney and advanced medical directives. As they go off to college, a lot of times schools will not provide you with information, or maybe, God forbid, they have an accident, they need a surgery. You're going to get asked in the hospital, do they have these documents? Luckily, I can say, yes, my sons all have them. I trotted them over to the estate planning attorney and got those. And then if they've inherited money or whatever, they may even need to have a will. But once you reach, age of majority, 18, you want to have those kind of things in place. And then, of course, if you haven't looked at this, but you have a sense that maybe you have a state tax issue, Maryland, DC, or you live in a different state. There are other states where the exemptions are $1 million or $2 million. We have clients in those states, so we really need to think about that. or are going to have an issue in 2026, then you need to start thinking about this. As I said at the very beginning, if you decide in January, or maybe even better, June of next year, you want to update your estate documents, unless it's an emergency, most estate planning attorneys are going to say, I'm sorry, you'll have to wait till 2026 or maybe 2027. You've moved states. Now, this isn't a reason that everything needs to be changed, but often advanced medical directives from state to state, the language is different. Sometimes you need to update your trust for the language of that state. And maybe, addresses have changed, intentions have changed, so that's always a good, again, you might not change them, but you would at least need to review them. Also mentioned already the children over 18. And then, as I alluded to much earlier in the presentation, over the last 7 years, many estate planning attorneys have made their lives easier and just set up family trusts. So when there are two spouses, instead of doing his and hers or his and his trusts, they're just doing a family trust. And that's been fine because we haven't had to worry about whose money is in what estate and are we trying to avoid estate taxes or any of that. That is coming back. And so some people who have family trusts who, as of 2026, will have a federal estate tax issue may need to revisit their planning. And again, you do not want to wait, but here's what you can do. I talked to an estate planning attorney about this, and he said, look, we're not funding, i.e. we're not changing titling on assets to his and hers, hers and hers, his and her trust, but we're setting them up so that if the tax law really does change at the end of 2025, very easy to make those changes happen. But if you wait until the end of 2025 or 2026 and then go, oh gosh, I've got a problem, again, you might be waiting to fix that. And as long as you think you're going to be on the planet, you're good. But we all don't know how long. Life is short, right? We don't know how long we're going to be on the planet. And then the last thing, and hopefully this seems obvious, is that maybe your bequest, your beneficiaries, no longer align with your wishes. That is a really important thing that we go through with our clients periodically is, are these all the people that, are they still alive? Do you still want them to get money, whether it's a charity or a person? Is this really reflective of the legacy? If we go back to the questions I asked you at the beginning, does that align with the impact and the legacy that you want to have? And as I said, whatever you name on your beneficiary designations is how that money will be distributed regardless of what your will and trust say on a broad basis. So it's really important to make sure it's all aligned. I'm going to stop there. I covered a lot of material on purpose. I want to get you thinking. I want to encourage you to be intentional and think about some planning. Obviously, we're going to be sharing this presentation with others. Any questions that anybody has?
Lisa, this was terrific. As you say, very, very comprehensive, easy to understand. And as you just said, it's going to be recorded. But what are your plans to get it out as broadly as possible to the congregation? Will there be letters, for example, to everybody, just so that...
So, this is part of a beginning process that we're going through. So I'll just say that if you have named St. John's in your estate planning and you did not see your name on the 1816 Society list the last time it went out, or you're not sure, you can let Preston know, or me know, either one of us, but I'm going to ask you, is this in your will? Is this in your trust? Is it a beneficiary designation? So one of the first things we're doing is that we want to go ahead and we wanted to do this session. We're going to have a reception for the 1816 Society members. We'd like to do some more education over the next year because we have a lot going on. I would love to do a piece about Dorothy Macaulay too. I think it's important to understand that legacy, and again, that's a very generous legacy. It doesn't have to be that big to be remembered. There's lots of different ways that you can be remembered here and certainly with other charities you care about. So I hope that answers it, Clerk. Thank you for asking. Yes,
Can I just
Renee.
briefly note, for running a charitable organization, of course, anyone can change their mind about their estate plans, but to have a general sense of what may be forthcoming. And statistics show that people who have planned gifts live longer. I'm sure there are lots of other factors that play into that, good, generous people. But the for the organization's sustainability and understanding
Yep.
of what may be for the future. And let's hope we all live long, prosperous lives. But I do want to note just that uncertainty that entities, charitable organizations like St. John's may have, because we just don't know what's forthcoming or what your intentions are. And I think because now we talk about things more, we discuss our lives on social media in different ways, and we talk with our families generationally to make your intentions known, and to not let it be a scary thing to say, I'm leaving this, or you're in my estate plans.
It's so much, we settle a lot of estates, and boy, it's so much better when everybody knows what's going on, I can tell you. It's so stressful otherwise. Justin, you were
I
going to...
have two questions for you to
Okay.
clarify, and I thank you so much, Lisa, for your time, and I always learn when you speak. So, qualified charitable distributions, you mentioned $105,000. That figure, does that index on an annual basis?
It does. It has an index. It hasn't gone up for a while, so this is our first bump up. It had been 100,000 for a while.
Yeah, that's news to me.
It
I
is.
think it's amazing. So just to clarify, because I know you have clients and households that have some pretty sizable required minimum distribution. So to clarify, that's spouse one contributing. or
105,
donating
spouse
up to
two, 105. Yeah, it's
so pretty significant.
Yep.
So that was my first question. Number two is going to be a silly question, and I'm sorry I'm sitting by Rob. I recognize in our annual pledges we get those nice letters with the forms that we can submit hard copy. We might get a call. I try to avoid those. But we can also sign up online. That was a new feature provided by our website. How in the heck do we pledge for the bell tower? I don't know that one.
you got to go to slide 16, as it turns out. So all the contacts are on there. Toby Stock is our point person on annual giving. David Galilee is handling the bell tower project, and then obviously me on planned giving. So thank you for setting that one up. There's one little pro tip I want to share, and this is important because you may have a little debate with your estate planning attorney, but good ones, I think, get it. So a lot of times people will make bequests in their will or their trust. It's right at the top of your document, and it'll say, I want to give $5,000 to Joe Smith or my nephew here or whatever, and then I want to give $10,000 to XYZ charity. So, pro tip, I will just tell you, if you don't have an estate tax problem, nobody is getting any tax benefit for that going to charity. So at least what my estate planning attorney told me to do is to tell my husband, Jim, that, okay, when Lisa dies, you're supposed to take some of this money you're giving and go give it to St. John's and to Stanford and whatever, and then he gets to take a tax deduction. So be thoughtful about the bequests. We'll talk about this later. But it's, unless you're going to have a federal estate tax issue, in that case, then anything going off to charities reduces your estate, and then reduces what your heirs have to pay in federal estate taxes. For many people, even with the change in the law, that's not going to be an issue. So be thoughtful about those bequests. It's got to be somebody you trust. I trust that my husband is going to remember, and you could put it in a letter. Hey, don't forget, you're supposed to, when you get that insurance policy proceeds, you need to stroke 3 checks to these places, but then he's going to get an income tax benefit. So that's just a little pro tip to think about, because otherwise estate planning attorneys will just have you name all kinds of charities and stuff in your documents, and it may not be the smartest thing to do from a tax standpoint. And what is it? I have one last slide, number 15, what to do next. So to do this well, you need to talk to your advisors, your financial advisor, your financial planner, if you've got a CPA, an accountant, if you've got to redraft documents, or you're thinking about a fancy charitable trust or something, all of that needs to be done with an attorney. So I want to encourage you. It's a team effort. You want to do this in a coordinated fashion, because sometimes you can have unintended consequences. You thought you did the right thing over here, but in fact you caused a problem over there. So it is worth meeting up with these folks, maybe even getting them together if you're doing something significant, to make sure that it makes sense for your personal situation, for the current tax laws, and also looking forward. The best advisors will help you look forward, not just look at today. So thanks very much, and thanks for those who are going to check out the presentation later. All right.